Palantir is making headlines everywhere right now with massive financial results. Today, we are stripping away the artificial intelligence hype to analyze this company using the strict math of value investing. We are looking directly at the fundamental business logic, the capital allocation, and the actual numbers driving this growth. A pure value investing explainer forces us to compare the fundamental business advantage against the actual valuation reality.
The news is absolutely dominated by Palantir's monster first quarter of 2026. The company generated $1.633 billion in total revenue. Earnings per share hit 33 cents. That means for every single share of stock, the company generated 33 cents of pure profit, beating Wall Street expectations by over 22%. Their United States government business alone grew 84% to hit $687 million. Following this massive earnings beat, Wall Street firms immediately set a $225 stock price target. The momentum is completely undeniable.
Analysts actually expect Palantir to become a $1 trillion company by 2031. They base this massive valuation target entirely on Palantir's artificial intelligence platform. This software manages multiple large language models at once. Large businesses use it to safely deploy AI agents directly into their private computer networks. A company can process its own highly sensitive data without sending that data out to the public internet. The market strongly believes this exact capability will drive the stock to a $1 trillion market cap.
Section 4. The ultimate switching cost.
Value investing is simply the strategy of finding companies with a lasting competitive edge and buying them for less than their long-term intrinsic value. You want a business that customers cannot easily abandon. You want a product that becomes completely essential to daily operations. Then you want to buy that exact business at a reasonable price relative to its future profits. You do not just buy a good company. You buy a good company at a logical price.
Palantir builds this competitive advantage through a software architecture called an ontology. Large organizations always have vast amounts of data trapped in disconnected systems. The human resources department data simply doesn't talk to the supply chain department data. An ontology maps a company's specific business logic directly to this raw data to automate operational decisions in real time. Embedding this software requires heavy upfront effort, and engineers must connect everything. Once installed, removing it becomes incredibly difficult and expensive. This creates absolute product stickiness. A company will absolutely not simply uninstall the software that runs its daily automated decisions.
The Kavanaugh construction contract proves this exact competitive advantage. Kavanaugh just extended its partnership with Palantir to serve as its digital operating system all the way to 2035. They are even commercializing these tools for the entire construction industry. This locks Palantir into the center of their operations for the next decade. It validates the strategy of turning early software trials into permanent, scaled deployments. When a company signs a contract that lasts until 2035, the switching costs are effectively absolute.
Section 8. Making AI highly profitable.
Deep software integration must translate into a profitable financial strategy. Palantir turns software dominance into actual cash very efficiently, making AI highly profitable. They use a bootcamp sales model. They skip the long sales pitches completely and deploy working software for the client in a matter of days. Customers experience immediate operational value. By drastically reducing the time it takes for a customer to see a return on their investment, Palantir completely removes the hesitation to buy. A client does not wait 6 months to see if the software works. They see it work on Friday. This rapid deployment leads directly to massive commercial revenue growth. The financial result of this sales process is staggering. United States commercial revenue grew 133% year over year to $595 million in the first quarter of 2026. The trailing 12-month contract value bookings reached $4.7 billion. The business is succeeding on a highly profitable scale. They are spending money to acquire customers, and those customers are signing massive long-term deals. The capital allocation efficiency is incredibly strong.
Section 11. The price tag reality.
A flawless business operation still has a valuation and a real cost to own the stock. Value investing requires analyzing the actual price of the stock, regardless of the underlying business performance. We must look at the valuation reality. The market has trillion-dollar expectations. Investors are currently paying 76 times the projected 2027 earnings for this stock. You are essentially paying $76 today for every $1 of profit Palantir is expected to make next year. Simultaneously, Wall Street projects Palantir's revenue growth will slow down from 85% recently to 45% in 2027. Paying a massive premium for a company with slowing growth presents a significant financial risk. The business is growing, and the pace of that growth is decelerating right as the stock price hits record highs.
Prices in the stock market historically return to normal averages. A more reasonable price-to-earnings ratio for this decelerating growth rate is 50 times earnings. If Palantir's valuation drops to that normal level, the stock falls 51% to $103.50. A simple return to a standard valuation erases over half of the investment value. Even if the company continues to succeed, buying at the wrong multiple guarantees a severe loss of capital.
Major institutional investors are already reacting to this high price. Renaissance Technologies held over 47 million shares of Palantir in early 2024. By the first quarter of 2026, they rapidly sold over 40 million shares, reducing their position to just under 7 million. Large funds are taking profits and moving their capital to alternative software stocks with less downside risk at current market prices. When the smartest money in the room starts aggressively selling, value investors absolutely must pay close attention to the valuation numbers.
Section 15. The long-term risks. This future growth narrative faces specific long-term risks. Even an excellent business model cannot ignore macroeconomic reality. To justify the current stock price and hit the 2028 market targets, Palantir must achieve unforgiving financial metrics. They need $10.8 billion in total revenue. They need $3.6 billion in total earnings, which is a $2.5 billion increase from today. This requires a 40.7% yearly growth rate every single year until 2028. The current stock price leaves zero room for execution errors. A single bad quarter destroys the math required to support this valuation. This highly demanding growth rate faces severe macro risks. Corporate budgets could tighten at any time due to economic conditions. Competitive software developers will introduce alternatives and force a price war. The entire investment narrative relies on a constant stream of new contract wins and rapid renewals. Any slowdown in customer spending immediately collides with the premium expectations priced into the stock. If a major client decides to reduce their enterprise software budget, Palantir loses a piece of the aggressive 40.7% growth requirement.
Section 18. The Value Investing Verdict.
The final value investing verdict comes down to a matter of balance. We must weigh the business quality against the required execution. Palantir possesses an excellent business advantage with deep customer integration and incredibly high switching costs. The current valuation simply demands absolute perfection in an unpredictable economy. The stock price requires the company to execute massive growth targets flawlessly without facing any budget cuts or competitive pricing pressure. The fundamental business is exceptionally strong. The stock price assumes that absolutely nothing will go wrong between now and the end of the decade.
Before we wrap up, please remember that the above content represents only a personal deep dive and analysis of business logic and does not constitute any form of investment advice. The market carries risks, so please ensure you conduct independent research before making any decisions. The most important metric to watch over the next year will be Palantir's profit margins. They will reveal whether the underlying business can truly justify this immense market valuation. The software is sticky, and investors must now decide if any software is truly worth 76 times its future earnings.